Picture yourself standing in the center court of a 750,000 square foot regional shopping mall on a Saturday afternoon in December. The parking lot is full. The food court has lines at every counter. Families are flowing between Macy's and Nordstrom carrying shopping bags from Zara, Sephora, Apple, and Lululemon. You own this entire complex. Every store pays you rent, not just base rent, but percentage rent on their sales. When Sephora does $8 million in annual revenue, you get 7% of every dollar above their break-even threshold. That's $560,000 from one tenant, on top of their $420,000 base rent. Multiply that across 140 tenants and the numbers become staggering. You're not just collecting rent. You're collecting parking fees, for dollars per car, 12,000 cars daily on weekends. That's $48,000 on a Saturday alone. You're leasing space to advertisers, digital billboards, charging stations, directory kiosks. You own the food court and take a percentage of every transaction. Every holiday season, you charge temporary holiday kiosks $12,000 for 6 weeks in the common areas. You've created a self-contained commercial ecosystem where every transaction enriches you. The barriers to entry are insurmountable. You cannot build a new shopping mall in 2024. The cost would be $250 to $400 per square foot or $187 million to $300 million for a facility this size. You bought this property in 2003 when it was still possible. Now you own an irreplaceable asset in a market with limited competition. This is the dream that makes private equity firms pay $400 million to acquire Class A malls in strong demographics. Here's what nobody tells you until you're drowning in $280 million in debt watching Macy's announce they're closing your anchor location and taking 180,000 square feet of foot traffic generation with them. A shopping mall is not a retail business. It's a leveraged real estate asset that functions as a traffic aggregator for retail tenants, where your ability to maintain occupancy and rental rates depends entirely on factors outside your control: consumer shopping behavior, anchor tenant corporate strategy, e-commerce penetration rates, and the financial health of mid-tier retail chains that are simultaneously your customers and your product. The actual mall, the physical structure, the common areas, the parking decks, those are cost centers consuming $8 to $14 per square foot annually in operating expenses. You don't control the businesses inside your mall. You're dependent on them succeeding enough to pay rent but not succeeding so much that they can negotiate better terms or leave for standalone locations. You're dependent on anchor tenants like Macy's, JCPenney, and Nordstrom to draw foot traffic, but anchors pay $6 to $15 per square foot while inline tenants pay $50 to $150 per square foot. You're subsidizing the traffic drivers to extract rent from the traffic beneficiaries. And the entire model collapses when anchor tenants close or when consumers decide they'd rather buy everything on Amazon. The economics only work when you understand that shopping malls are not permanent fixtures of American commerce. They're a 60-year commercial real estate asset class entering terminal decline. And the only operators still making money are the ones who either bought at massive discounts during distressed cycles, are aggressively converting dead anchor space to experimental uses, or are executing controlled demolitions while harvesting cash flow before the inevitable sale to a residential developer. Once you understand that, everything else makes sense. Let's start with the acquisition cost that separates institutional investors from everyone else. Buying a Class A regional shopping mall costs $150 million to $600 million depending on size, location, and occupancy. A 750,000 square foot mall in a strong suburban market with 92% occupancy trades at $280 to $380 per square foot. That's $210 million to $285 million for the asset before you spend $1 on operations or improvements. Financing a mall acquisition requires 35% to 45% equity. Lenders won't go higher than 60% to 65% loan-to-value on mall properties due to sector risk. On a $250 million purchase, you need $87.5 million to $112.5 million in equity capital. This is institutional money, pension funds, private equity real estate funds, REITs. Individual investors cannot play at this level. Before we get to the revenue model, there's a cost almost nobody budgets for: deferred maintenance and capital improvement backlogs. The previous owner deferred roof repairs, HVAC replacements, and parking lot resurfacing to inflate cash flow before selling. Your initial capital expenditure requirement runs $15 million to $35 million in years 1 and 2 just to address deferred maintenance. Operating expenses are where the real costs live. A 750,000 square foot mall incurs $6 million to $10.5 million in annual operating costs. Common area maintenance, cleaning, landscaping, snow removal, lighting, FAC for corridors and food courts, runs for $2 to $7 per square foot or $3 million to $5.25 million annually. Property taxes run $2.5 million to $4 million annually. Insurance costs $800,000 to $1.4 million annually. Utilities for common areas run $1.2 million to $2.1 million annually. Security requires 24/7 coverage, uniformed officers, surveillance systems, vehicle patrols. Security costs run $1.1 million to $1.8 million annually. In malls experiencing crime increases, security costs spike 40% to 70% as you add personnel and implement stricter protocols that hurt the shopping experience. Marketing budgets run $600,000 to $1.3 million annually, radio, digital ads, social media, holiday events. Without marketing, foot traffic declines, sales decline, and tenants start missing percentage rent thresholds. Management fees run 3% to 5% of gross revenue. If your mall generates $28 million in annual rent, you're paying $840,000 to $1.4 million to a professional property management firm. Tenant improvement allowances destroy cash flow. When you sign a new tenant, they demand $40 to $120 per square foot in tenant improvement allowances. A 4,000 square foot retailer at $75 per square foot requires $300,000. Sign 10 new tenants annually and you're spending $2.5 million to $3.5 million just to maintain occupancy. Debt service is the killer. On a $250 million acquisition financed with $162.5 million in debt at 6.5% interest, your annual debt service is $13.9 million. This is a fixed cost that doesn't care whether your occupancy is 95% or 78%. Add it up. Operating expenses $8.5 million annually. Property taxes and insurance $4 million. Marketing and management $2 million. Tenant improvements $3 million. Debt service $13.9 million. Total annual requirements $31.4 million. You need $31.4 million in net operating income just to break even. Most people who fail here don't fail for dramatic reasons. They fail because of 3 structural traps that have destroyed hundreds of mall owners since 2015. The first trap is anchor tenant closure cascade. Your mall has 4 anchors: Macy's, JCPenney, Sears, and Dillard's. They occupy 420,000 square feet, 56% of your space, but pay $8 to $12 per square foot while inline tenants pay $65 to $110. You're subsidizing anchors because they drive 50% to 65% of total foot traffic. When Sears closes, you lose 105,000 square feet. But the damage is worse than lost rent. Foot traffic drops 18% to 28%. Inline tenants near the closed Sears see sales decline 25% to 40%. They trigger co-tenancy clauses allowing them to pay reduced rent or terminate entirely. You lose $180,000 from the Sears space, but you lose another $850,000 to $1.2 million from inline tenant rent reductions. Total impact, $1.03 million to $1.38 million in lost annual NOI. On a 7.5% cap rate, that closure reduced your mall's value by $13.7 million to $18.4 million overnight. The second trap is e-commerce sales transfer and percentage rent erosion. Your model includes base rent plus percentage rent, typically 6% to 9% of sales above a breakpoint. A tenant paying $75,000 base with $2.8 million in sales pays an additional $126,000 in percentage rent. But tenants are shifting to omnichannel. Customers browse in-store, buy online. The in-mall location reports $2.1 million in sales instead of $2.8 million. You lose the entire $126,000 in percentage rent. Multiply across 40 tenants and e-commerce attribution shift costs you $1.8 million to $3.2 million annually in lost percentage rent. The third trap is reinvestment requirement acceleration. Malls require constant reinvestment, bathroom remodels, food court renovations, facade updates, AVAC replacements. Typical reinvestment is 12% to 18% of annual revenue or $4.8 million to $7.2 million annually. When the mall struggles, you defer reinvestment to preserve cash. By year 3, the property looks tired. Customer surveys mention dirty bathrooms. Occupancy drops from 89% to 81%. You lost $3.2 million in annual NOI trying to save $5 million in capex. Here's the part that changes how you see this entire business. Shopping malls make money through a multi-layered revenue model where 65% to 75% of profit comes from inline tenant rent, 8% to 15% from percentage rent, and the remainder from parking and specialty leasing. Base rent from inline tenants is the foundation. A 750,000 square foot mall with 330,000 square feet of inline space leased at $78 per square foot generates $25.7 million annually. Anchors occupy 420,000 square feet at $10 average, generating $4.2 million. Total base rent, $29.9 million. Percentage rent adds meaningful upside. 40 tenants hitting thresholds contribute $3.8 million to $6.2 million annually. This is pure margin, no incremental cost. Specialty leasing generates high-margin revenue. 20 holiday kiosks at $8,000 to $15,000 for 6 weeks generate $160,000 to $300,000. Vending machines, ATMs, charging stations add $280,000 to $520,000 annually in pure profit. Now the math on a performing mall. Total revenue, $29.9 million base rent plus $4.8 million percentage rent plus $400,000 specialty leasing equals $35.1 million. Operating expenses, $14.2 million. Net operating income, $20.9 million. Subtract debt service of $13.9 million. Cash flow before capex, $7.0 million. Subtract $5.5 million in capex and tenant improvements. Net cash flow, $1.5 million annually. On a $250 million asset requiring $100 million in equity, you're generating $1.5 million. That's a 1.54% cash-on-cash return. You're not making money on cash flow. You're betting on appreciation or buying distressed assets at $140 per square foot hoping to sell at $220. Now we get to the number that actually determines everything, occupancy rate. Every 1% decline costs approximately $330,000 in annual NOI. A drop from 92% to 84% costs $2.6 million in annual NOI. On a 7.5% cap rate, that's a $35.2 million decline in property value. Occupancy is survival. These numbers are based on industry averages and should be treated as a framework for thinking, not a guarantee. Malls are not high cash flow assets. They're appreciation plays or distressed turnarounds. Let's talk about CBL Properties, a mall REIT operating 100-plus properties that filed for bankruptcy in 2020 with $2 billion in debt. What killed them? Anchor closures and declining occupancy. Portfolio occupancy dropped from 92% in 2015 to 84% in 2019. Revenue declined while debt service remained fixed. They couldn't refinance maturing loans. This is not poor management. This is structural shift, e-commerce penetration rising from 7% in 2010 to 16% in 2020, destroying mid-tier mall economics. Now take Brookfield Properties and their reinvention strategy. Brookfield owns 130-plus malls but focused on Class A properties in top markets. When anchors close, Brookfield converts space to experiential uses. A former Sears becomes Lifetime Fitness, a bowling alley, Topgolf, or luxury apartments. They're transforming malls from shopping destinations into mixed-use lifestyle centers. At Oak Brook Center outside Chicago, Brookfield added luxury residences, a boutique hotel, and fine dining. The mall remains 96% occupied. Brookfield's Class A malls trade at $400 to $650 per square foot while Class B malls trade at $80 to $180. The gap is execution and location. Here's what the smartest operators do differently. They don't just collect rent and hope retail survives. They monetize every square foot. First, data monetization. Your mall generates consumer data, foot traffic patterns, dwell times, demographics from Wi-Fi tracking. Sell anonymized data to retailers for $180,000 to $450,000 annually. Partner with digital advertising networks for $220,000 to $580,000 in ad revenue. Second, event space rental. Common areas host corporate events, product launches, fitness classes, concerts. Charge $5,000 to $25,000 per event. Host 30 to 50 annually and generate $300,000 to $750,000 while driving foot traffic. Third, converting dead anchor space to non-retail. A 120,000 square foot former Macy's becomes a trampoline park, $12 to $18 per square feet, medical center, $22 to $32 per square feet, or co-working space. You're trading $10 per square foot anchor rent for $18 to $32 per square foot alternative use while maintaining traffic. Here is the honest math, not the pitch deck version. Good year scenario. Your Class A mall maintains 94% occupancy. Base rent, $31.2 million. Percentage rent, $6.1 million. Other revenue, $1.8 million. Total, $39.1 million. Operating expenses, $14.8 million. NOI, $24.3 million. Debt service, $13.9 million. Pre-capex cash flow, $10.4 million. Capex, $5.2 million. Net, $5.2 million on $100 million equity, a 5.2% yield. Bad year scenario. Macy's closes. Occupancy drops to 86%. Base rent, $27.1 million. Percentage rent, $2.8 million. Other, $1.4 million. Total, $31.3 million. Expenses, $14.2 million. NOI, $17.1 million. Debt service, $13.9 million. Pre-capex, $3.2 million. But you need $8 million to convert Macy's space. Net, minus $4.8 million. You're losing money and property value declined from $324 million to $228 million. Stay with this because the final calculation changes everything. The gap is a $10 million cash flow swing and $96 million property value decline, all from one anchor closure you couldn't prevent. You control maintenance but not Macy's corporate strategy or Amazon's market share. The person who wins is not a retail visionary. The winner is a distressed debt investor who bought Class A malls at 40% to 60% discounts during 2009 to 2012 or 2020 to 2021. Or a deep-pocketed institutional investor executing mixed-use conversions in irreplaceable locations. They have capital to hold through anchor closures and retenant over 18 to 36 months. They're playing a 7 to 12-year value-add strategy where they bought at $140 per square feet, spent $60 per square feet on repositioning, and exit at $240 per square foot. They have relationships with non-traditional tenants, Lifetime Fitness, Whole Foods, medical groups, entertainment concepts, to occupy former anchor space. They're transforming the use case entirely. Here's the counterintuitive truth. The best mall owners today are real estate repositioning specialists who see malls as redevelopment opportunities. Some malls are worth more dead than alive, demolished and redeveloped as mixed-use, multifamily, or lifestyle centers. The winners recognize which to save, which to transform, and which to harvest for land value. So, let's go back to that Saturday in December with the full parking lot and buzzing food court. The families are still carrying bags. But now you see it differently. That full parking lot is a temporary spike disappearing in January. Those Lululemon bags represent sales that could have happened online, and every year more do. That Macy's anchor has your location on a closure watch list you're not allowed to see. The romantic version was about owning a commercial town square generating passive income forever. The real version is understanding that shopping malls are a 60-year asset class in structural decline. The only operators making money are harvesting cash while planning exits, executing billion-dollar repositioning in trophy assets, or buying distressed properties at $90 per square feet hoping to flip at $160 before the next anchor closes. You can make money if you bought right, have patient capital, can execute complex repositioning, and operate in top 25 markets. But the fantasy version, stable, high cash flow, appreciation guaranteed real estate, ended somewhere between the iPhone and Amazon Prime. What's real is this: you're operating a $250 million asset where one Macy's boardroom decision can destroy $96 million of value overnight, and there's nothing you can do to stop it. The cash flow barely covers the capital needed to delay the inevitable. You're not investing in real estate. You're executing a controlled demolition with rent collection. And the only question is whether you exit before the music stops.